Everyone keeps telling you to buy Nvidia when it touches its trend line. The logic sounds airtight. The line is drawn, the price respects it, history repeats, profits follow. But that advice assumes something that hasn't been true for about 18 months now. And if you're still trading on that assumption in a world where the Fed is holding rates at 3.5% with no cuts in sight until sometime next year, you're walking into a very expensive mistake. The mistake isn't that trend lines don't work. The mistake is that traders treat them like they're independent of the macro environment, as if a line drawn on a chart in 2023 carries the same weight today. It doesn't. And nowhere is that gap more dangerous than in Nvidia, where a single trend line is doing the work of 5 different regimes at once. Here's what's actually happening underneath. A trend line is nothing more than a historical narrative. It's a way of saying, in the past, the stock respected this level. The problem is that Nvidia's macro narrative has inverted. 2 years ago, every dip to a trend line was a buying opportunity because growth was coming, rates were falling, and the Fed was on a cutting path. Investors who bought Nvidia on those dips made money because the backdrop rewarded tech. Today, the Fed isn't cutting anytime soon, duration risk is real, and growth stocks face multiple compression. A trend line that held because the macro was tailwind is suddenly a very different animal when the tailwind turns to headwind. Think about what that means for the numbers. When Nvidia bounces off a trend line now, the bounce is happening in an environment where the cost of capital to fund AI infrastructure is structurally higher than it was 2 years ago. The Fed's holding at 3.5 to 3.75%, and even when cuts do come, and they're not coming until next year, they're priced in at a pace that's slower than the market was betting on 4 months ago. That's a quiet but fundamental shift in what justifies a megacap trade on a technical level. A trend line doesn't know about that. It just sits there waiting to be tested. The reason this matters specifically for Nvidia is that the chip maker's valuation is built on a very particular story. Explosive earnings growth fueled by AI adoption, runway that extends years out, a moat in the data center market. That story is true. But that story also demands that investors discount future cash flows at a lower rate than they are today. The higher the Fed stays, the more of that story gets discounted out of the stock. So when Nvidia's trend line is tested this week or next, the price might not break below the line. The line itself might be the wrong frame for understanding where real support actually lives. Here's the difference between a chart that's held and a chart that's actually structurally sound. A held trend line in a downtrending macro environment can look stable right up until the moment it isn't. And here's the kicker. By the time a megacap tech stock breaks a major trend line, it often falls hard and fast, because the breakdown proves that the macro case has gotten materially worse, and institutional traders who were waiting for that confirmation start selling at scale. You don't get a slow decay through the line. You get a breach followed by a crash. The thing that makes the current setup particularly treacherous is volatility. The VIX is sitting at 16.5, which is calm. That's the level where traders get confident, where they lean harder into technical levels because everything feels stable. But calm volatility and a hawkish Fed create a dangerous combination for trendline traders. The calm makes you think the trend line is safe to buy. The hawkish backdrop is quietly rotting the fundamental case. And the moment something hits the news cycle that refocuses traders on duration risk, and believe me, something will, the confidence evaporates and what looked like a safe dip becomes a collapsing support level. Now, the bull case is real and worth stating clearly. Nvidia's artificial intelligence positioning is structural. The company is printing earnings growth that justifies the price in a lower rate world, and the market will eventually get to a lower rate world. If the Fed surprises and cuts sooner than expected, or if the geopolitical backdrop and the Iran peace talks in the news today suggest there's room for surprise there, shifts growth expectations higher, then Nvidia's trend lines snap right back, the stock rallies hard, and anyone who was patient on the dip makes a lot of money. That's the bull thesis, and it's not frivolous. The bear case, though, is darker. Trendline support in megacap tech fails most catastrophically when the macro backdrop shifts and nobody prepared for it. If the market reprices growth lower because the Fed's duration story gets worse, or because earnings guidance starts to roll over, or because there's a surprise shock to the AI narrative, all of which are possible given where we sit, then Nvidia doesn't drift down to test the trend line. it drops below it and keeps going because the breakdown proves that the old assumptions were wrong. And that's when the real damage happens to trendline traders. They were waiting to buy what they thought was support, and instead they got confirmation of a bigger shift. Here's what that means if you're actually watching Nvidia this week. The safe way to play a trendline setup in this environment is not to treat the line itself as your signal. The line is data, not destiny. What matters is what the price action around the line is telling you about where real support has migrated. If Nvidia dips and the line holds but it holds on lower volume, or the bounce fails to recapture the previous day's highs, or it fails to break above key moving averages on the bounce, then the line itself is lying to you, the structure underneath has rotted. That's your signal to assume the line is about to fail, not to load up and wait. Conversely, if a dip to the line shows strong reversal signals, volume on the bounce, institutional buying pressure, then you have a setup with real conviction behind it. By that, not the line. And here's the critical piece. Size your position for a break. This is where trendline traders most often go wrong. They assume the line will hold, so they size up. But if your assumption is wrong, and in a hawkish Fed environment, the odds of your assumption being wrong are higher than the chart itself would suggest, then that oversized position gets run over fast. The disciplined approach is to assume the line might fail, position small, and let the technical confirmation tell you whether it's safe to add. If it holds, you'll have other opportunities to build size. If it breaks, you've protected yourself. The broader point is this: markets aren't pure technical systems. They're macro systems with technical patterns embedded in them. When the macro shifts, the patterns that worked stop working, not gradually but suddenly. Nvidia's trend lines are real. The question is whether they're real because Nvidia is fundamentally still sound at that level, or whether they're real only because nobody's been tested on whether the macro still supports them. And right now, with the Fed hawkish and rates staying put, that test is coming. Watch the line, but watch what's underneath it. That's where your edge actually lives. If you want to follow along as the desk works through setups like this in real time, tickers, levels, probabilities, when to scale in and when to stay flat, join us in the Discord. We're posting every trade, every thesis, every time we're wrong, so you can learn from what's actually working in the tape right now, not just what the charts say should work. Educational only, not financial advice.